Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Tuesday's Stock Play of the Day, we talked about ExxonMobil. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at a long call option in ExxonMobil. I am now highlighting the long call option inside the Ally Invest Options Playbook. It's a very straightforward strategy, and we've looked at a lot of call options. We've had a fairly bullish market and over the actually pretty good, doing pretty well, even though February is traditionally not a very good month, but we're actually having a fairly decent February right now. So we looked at ExxonMobil. We did a little bit more of a fear of missing out. Not a lot of the energy stocks have been in the news, but we've had a decent run up in oil. Now, today, oil is down about 1%, but we see ExxonMobil up just a little bit. So let's start by looking at what ExxonMobil has done over the week. Now, what I'm showing you is a 15-minute chart that starts at noon on Tuesday. We always kick off the Stock Play of the Day. It's a live show using live market data, not meant to be a recommendation, but we're using live market data. And we looked, as we started the show, the stock was actually down a little bit. It was down around 51 3/4. By the time we put the trade on, according to my snapshot that I took on Tuesday, stock was right around 52. So in general, the stock has really not gone anywhere. If you look at this, these are just quarter increments up here. So the high that it has been since Tuesday is about 53.25. So that's a decent move to the upside, which overall, when we look at the charting pattern that we were seeing, was a good thing because we really wanted it to close above this 52 level and continue on up, because the chart kind of looked good if we could break out a little bit to the upside. But where we have it right now is 52.32, so a little bit above the 52 level where we're at. So the option strategy that we did is a little bit up also to go along with the underlying stock price. Now, the charting pattern that we were looking at, I'm going to highlight, this is basically the chart that we were looking at on Tuesday. And I just drew a little line here, which was an area that we were focused on. We saw a little bit, a good run up a few weeks back, right around the 52 level. And if I draw a couple of channels here, let's just grab this little ray tool and we look at it. This is a little bit of a nervous area as far as the chart is concerned, in that we really need to break out and set a new high up around the 52, 53 level. And we had that move already. So if we don't continue that move, and it is a Friday going into the weekend, if we're not able to stay above this 52, well, right now it's 52.30, let's call it 52 level, that could be thought of it as a bearish sign. If we close somewhere down around here, well, then this area comes into play. So ideally, like, you could draw this channel, we could go all the way down here, make it a little bit more of a longer term channel. You can see the way that the stock has actually moved. Throughout here, we're setting higher highs and higher lows all the way through. We came down, almost hit the bottom of the channel here, made a good strong run up off of that, touched the channel here, all the way back up. So even if you go out on a longer term basis, you can see that this area in here would be in limbo if we can not establish a higher channel, a higher trading range, I guess is a better way to say it. Now, ideally, we would like something like this to start, and then we basically start building a new higher channel and seeing higher highs and higher lows to the upside there. But it's not happening. So what could we do? What's an alternative here? Let's go back and actually look at the trade. So ExxonMobil, as I said, is up, well, about 0.5%. but it's good that it's up. It's up 29 cents right now. Oil is down 1% approximately, hanging right around $60 a barrel on the futures. And we see that, as mentioned before, that we did have a big dividend paid, and that's also worth noting in ExxonMobil. Lindsay Bell actually talked a little bit about that big dividend, 87 cents on a quarterly basis that gets paid. We went out till April. Now I'm highlighting the March contract right here that's only 14 days away because we're going to use that. We're going to talk about selling a call against our longer term option position. But this was the underlying trade that we looked at. As always on the stock play of the day, we're not meant to be a recommendation. We're just calling these paper trades because we're just trying to learn here on certain situations of what you might want to do and how you might want to use options to participate in stock price movement without all the risk. So we were saying that if you were thinking about buying 100 shares of ExxonMobil, what's an interesting alternative to where you could participate in some of the stock price movement without having all the risk of buying 100 shares of stock. And what we came up with was a 56-day, April 16th option contract. Actually, it would have been about a 60-day option contract, right? Because we talked about it first on Tuesday. That underlying option, when we looked at it and we looked at our paper trade, and I grabbed my screenshot, the stock was down a little bit at that point in time, and it was trading for, at the midpoint, right around $7.90. That meant your total risk was $790 plus commission on that trade. We see that it's trading at the midpoint right now at about 810. So there is a small profit on it, but we were really kind of waiting for the trade to play out. It'll be really interesting to see where the underlying stock closes based off of what we saw on the chart today. If we can maintain this level above, or even a little bit of more of a blip up, but it's going to be tough with oil prices trending down. Overall, if we were to close out this trade, what I would look to do is the exact opposite of what we talked about on Tuesday. Instead of buying to open the contract inside the Ally Invest option chains, I would sell to close. So I put the trade over in the right rail. I click sell to close on that position. I'll scroll up here a little bit, and we'd be selling that same contract, the April 16th, 2021 45 strike call. I'd want to work it somewhere near the midpoint, right around 810, and then I'd hit preview order, and I'd be sending that to the floor. So I'd really be selling to close one contract of the XOM April 16th, 2021 45 strike call at a limit price of 810. Good for the day. Now, if I did that, there's no guarantee of a fill, but whenever we're trading option contracts, very rarely are we just going to go at the market. Why? Because the markets just aren't as tight as they are if you're trading the underlying stock. A lot of time in ExxonMobil, the underlying stock is a penny wide, so entering a market order just to get out, you're just giving up a penny, not that big of a deal. On the options world, I would say 97% of the time, if I'm entering an order just to buy one option contract or just to sell one option contract, which we're highlighting here, I'm going to enter it as a limit order saying, I want this price. And if I don't get that price, then I'm not going to get an execution, i.e. a fill on my trade. And I'll have to adjust the trade and hopefully get a fill at a different price at a different level overall. But that's the concept. Okay, so let's get into a possible adjustment on your paper trade. If you were looking at this trade, you're saying, well, and it's going to be a little bit more bearish if it closes down below this level. If we can't necessarily break out to the upside, which would be a positive thing as far as technical analysis is concerned. If we can't make that move, well, then it becomes a negative situation if it closes a good bit below our actual trend line that we had drawn on the chart. So with that said, maybe it could be a time to think about doing a fig leaf, which means we have a longer term option contract and we sell a shorter term call against it. I'm highlighting the fig leaf here inside the options playbook. So I would go a little bit shorter term, and I'd be thinking about just selling a call against that position. Now, we have something that acts like the stock, but it's not the stock. And hence, that's the name of the fig leaf. A lot of people will reference it as a leverage covered call. But in this instance, we're saying we're going to sell a call against our option position that has a large delta, acts a little bit like the stock. We got a decent move up in the stock, and the option contract took a good chunk of that, right? We paid $790 for that underlying option on Tuesday in our paper trade. And today we see it trading at 810. That means the stock went up a little bit, and we actually got a decent amount of that little bit that the stock went up because we had some delta. We went deeper in the money, bought a real option contract. Now we're going to go out of the money when we consider the fig leaf. So let's go back to the Ally Invest option chains. Trying to guess where they are. There they are. And now you see why I kept the March 5th expiration. If I'm doing a fig leaf, I don't own the stock. I didn't pay as much for the stock either. So I'm going to sacrifice premium to be able to go shorter in time because I don't want to be assigned and a little bit further out of the money. Where if I was doing a covered call on my 100 shares of stock, I'd probably look for a premium around $1. In this instance, we're going to look at something that's trading for around 50 cents that only has 2 weeks to that expiration date. So in this instance, and you can decide here, we know that when we bought this option contract, by looking at the put, that gives you a hint to the time premium in the call. And right now, the put on the right-hand side on the chains is trading right around 80 cents. Let's call it at the midpoint. So that's how much time premium exposure that we have. So if we can go out 14 days in time and take away half of that time premium exposure, you'd be looking at selling either the 56 strike call or the 55 strike call. Now, keeping the theme that I don't want to be assigned, 50 cents sounds great, right? Relative, because you're taking more than half of the time premium that you paid for that option contract. But I would probably look at selling the 56. So we're going to make that the, I guess, paper trade for the overtime edition. And your position would look something like this. I would be long the 45 call from Tuesday, and I'd think about selling the 56 call against it, creating a fig leaf in my account. It would be covered. There's no more additional margin. I'd bring in about 35 cents, and then I'd want to watch it. I don't want to be assigned. If the stock does get to 56 over the next 14 days, I'm going to have to either close out the entire position, be prepared for that, or maybe roll this option contract out in time. And there is a section inside the Options Playbook website that is called How We Roll, and discusses the concept of rolling a call out and up in time if that option contract that you sold becomes in the money. That's it for this edition of the Stock Play of the Day Overtime. Now, don't forget to click subscribe and ring the bell. And if you do that, you'll get all the alerts, and we'll see you this Tuesday for the next Stock Play of the Day. And also, I want to remind you that next week we will be doing a digital conference, which will be almost all day long on Thursday. Please check that out on the Ally Invest YouTube channel. Thanks for coming, everyone.